from your perspective, have you seen, a shift in investing patterns since COVID, building on what Mark and Robin are saying, but uniquely from your position in Hong Kong and Asia?
First of all, I mean, as we all know, this has been a good year for bullion dealers globally. So I think at last we're all pretty happy. So definitely, I mean, there's increase in the activity in this market specifically. But what I see, I'll tell you, usually when we look at high net worth clients, the experience I had in the last 10 years is of a very, I would say, rational, organized investment in a way. They sit, they discuss, there's allocation in the portfolio. A lot of the time you will not talk with the principal, with the client himself. You'll talk to the lawyer, to the family office, to the banker. But my feeling is the last few months, it became more personal and more emotional. So before that was like, we sit with the family office and we decided to allocate 5%, 10%, 15%. We're going to do this. We're going to put, $10 million in Hong Kong, $10 million in Zurich, some in Toronto. It seems like, and I've been getting WhatsApp, okay, I got $200,000 released tomorrow, buy gold. So it became a bit more emotional, a bit, I would say, maybe affected with the maybe the fear factor, both the fear factor and the price appreciation. So clients don't want to lose the price appreciation on the one hand, and on the other hand, they're a bit afraid of the incoming uncertainty. It feels in a way, and I think many of us share the same feeling, like there's a shift in the world. The world is changing. It's changing very quickly. And there's some fear that maybe who knows what will happen tomorrow morning. So what we see is a bit more emotional, even spontaneous transaction. So there's money released. They sold an asset. They sold their bond portfolio. They sold their equities in an asset. They didn't exit no matter what. They sold property. Immediately, it's kind of purchasing in batches as the money becomes available, rather than sitting and organizing it and thinking very thoroughly of the geographical diversification and so on. So it really becomes something that is a bit more spontaneous, and it's something we have to, of course, we're happy for the business and we need to accommodate it. And again, it seems like with the various means of communications, it's easier. Clients are more eager to pull the trigger than before. I mean, when they want to do it, they want to do it now. They want to execute it. They want to know their money is safe. I mean, already we heard from Robin and from Mark about the safety and the hedge and so on. So they want to move that, and they want to move quickly, just because of the fear of what's going to happen tomorrow, or because who knows, maybe tomorrow we're going to lose another 5% on the price, right? I mean, remember, gold appreciated year to date around 20% since January 2019. We're up 50% or so. For sure, silver gone much higher, much faster. So I think they want to ride this wave as long as they can.
Do you find that clients working with wealth managers, maybe using some of like the ETF or other instruments, gives them actually a taste for investing in gold, and then when they see how that performs, it makes them want to buy physical? Or how do you see working with wealth managers and what that might throw up for your business?
Right. Listen, I can tell you there's definitely a lot of education to be done in the market. And I mentioned we were still having live events, doing a lot of live events with wealth managers and independent financial advisors. If you ask how many of their clients are invested in gold, you get we get a lot of hands. People are familiar with this asset. If you ask them how many of them are invested in the physical, it goes down to really a handful of hands. And there are two reasons. One is lack of knowledge. People think it's complicated. People think it's expensive. And as Robin mentioned, the differences in the price today is pretty negligible in terms of ETFs versus physical. And they don't know how to do it. Again, luckily, we have today a pretty robust ecosystem. And just see of the panelists here today, we really managed to gather some of the top guys in various countries. So there's more openness to this. But what we do see is that even if they had ETF, now they want to move to physical for everything, all the reasons Mark mentioned. I mean, all the fear of the counterparty risk, wanting to have their own assets. So one of the things, and the first year actually we've been asked, is how to match the prices technically, because they will tell us, I'm going to sell my ETF portfolio. I don't want to get exposure to the price. How I go around it. So that's definitely something that gives them more appetite. Of course, and I mentioned earlier and in chit-chat before this panel, the wealth managers has to be open for this discussion. If the view of the financial advisor is only AUM, my commission, it would not work. What we realized, the most successful partnerships we have, and we work with a lot of private banks and wealth managers, is when they look at it as really as protecting the client. And if they think outside the box and they really think about protecting their clients and not about their fees, then there's a room for cooperation. Then the clients are very happy, and then it's a successful partnership. And yeah, so the ETFs help, but you need some openness from the relationship manager.
Absolutely, holistic advice is essential. And just, I mean, obviously, the turmoil in Hong Kong, it would have been on a lot of people's minds, on investors' minds. I mean, for you, from being based there and being inside that, I mean, what was the impact on the sort of precious metals market on your day-to-day business as you proceeded through last year? And obviously into this year, we've got different challenges, but, you know.
Yeah, I mean, let's put it this way. Hong Kong had two roles, I would say, for the bullion market. One, it was really a trading hub, especially for gold moving to China. So we would see a large gold bars, old gold bars moving from London, shipped to Hong Kong, being refined there. We have two London LBMA, London approved refiners here, and then being imported to China. The immediate, I would say, effect of the riots, of the protests, was that we saw gold coming from elsewhere. The Chinese government said, okay, we'll buy gold, but we're not going to move it through Hong Kong. So we saw, for example, we saw an increase in the export of gold from Australia directly to China, or from Switzerland directly to China. So we saw less of the trading onshore in Hong Kong. That's on the institutional level, I would say, on the bank and the central bank level. As the private investors, definitely we saw move of gold from Hong Kong to Singapore and to Zurich, notably Hong Kong, Singapore and Zurich. Between the protest, the riots, no matter how you call them, last summer, and the enactment of the national security law in July 1st this year, again, fear factor, clients would pick up the phone and say, please take my gold elsewhere. Luckily, we have an office in Singapore and we store quite a lot of gold in Zurich, so it's very easy for us to move it. But it is actually, I mean, I've been here for 10 years, it is sad to see, but we estimate about 10% of gold held by private investors. We estimate about 10% of it moved elsewhere. Now, 10% is not the majority. And I have to say, we take a different approach, for example, that Rotbart, or I know some of the companies in Zurich taking of actually telling clients, move your assets away. We believe Hong Kong is still a very safe environment. But of course, when it comes to where to store the gold, and I think Robin mentioned it, it's the comfort or the trust of the client. It's the perception of risk rather than the risk itself. I can tell you, even now, I have some clients, I can tell them, listen, do you want to store in Singapore? Like, oh my God, no, it's a one family enterprise. What happens if the family is gone? You know, so obviously these people are not happy. In 2013, 14, 15, we moved so much gold out of Geneva to Switzerland because they were like, oh my God, Switzerland in the middle of this big credit crisis of the EU, no way, move us to Singapore. And I can tell you, I have actually quite a lot of American clients saying, oh my God, Hong Kong, of course, I want my gold protected by communist China because there's no way they will give our gold to my name to the Americans.